All right, everyone. Thank you very much for joining us today. We are very excited to have you here for our presentation on solo 401ks and employer-sponsored plans. We're going to teach you how to save thousands on your taxes while adding thousands to your retirement account. My name is Alex Perney. I am a business development specialist here at Advanta IRA. I've been here since 2012. If you have any questions regarding this presentation, feel free to reach out to me directly. My contact information is right down there at the bottom of the screen. I'll let my colleague Larissa give her own introduction. Just real quick, Larissa, if when we trade off, just don't move the mouse. It takes a while for the lag between it. I found that out when I was doing another guest presentation. So just don't touch the mouse if the other person's doing it. It goes a little smoother.
Yep, no problem. I hope everybody's having a great day so far. We're going to talk to you today about 401ks and hopefully answer some questions you have on these types of accounts. My name is Larissa Green. I've been with Advanta since 2011. Prior to doing business development and education, I worked in the back office along with my associate Alex, and we did anything from transactions to depositing checks and new accounts. And so now we have both been working in business development for quite some time now, and we teach classes all the time. We also have some other classes we'll talk to you about coming up here shortly. But with that, I'm going to allow Alex to have control of the screen and take it away.
All right. Thank you very much, Larissa. So a few things about Advanta. We've been in existence for over 20 years. We have a lot of experience in doing self-directed IRAs, 401ks, defined benefit plans, really anything that falls under the umbrella of a self-directed retirement plan we can handle. Any type of cash deposits that you have here at Advanta are FDIC insured up to their applicable limits. We're really proud of the fact that as of last year, we crossed over the $1 billion threshold for assets under management for our clients. That number is a little bit lower. Actually, I think as of last count, it's a little bit closer to $1.4, $1.5 billion worth of assets under administration for our clients. So we have a lot of experience. We have a lot of hands-on knowledge and a large diversity and wide array of investments that we've handled for our clients. So if you have questions not so much pertaining to the actual specific functions of the 401ks or retirement plans we're going to be covering today and want some more questions answered regarding the investments, feel free to do so. Both Larissa and I combined have almost 20 years of experience together just in doing these types of accounts and this type of investing. So please feel free to ask. And if you do decide to become a client or you are a client, you are familiar with it, every single client here at Advanta has a dedicated account manager that's assigned to them. They are the single point of contact that you go to for all investments, contributions, questions regarding your accounts, really anything. It's a really great program that we're proud of. It really helps to put the customer first in their experience with self-direction, first and foremost, with regards to what we're doing. A little bit of a legal disclaimer before we get started. Advanta IRA and our employees, we do not provide investment, legal, or other advice to our clients, nor do we promote or endorse any investment product. All information and materials today are for educational purposes only, and all clients are encouraged to consult with their financial advisors, attorneys, or accountants before entering into any type of investment. So a few key takeaway points today that I'd really like you to make sure that you take from this are the much larger contribution limits that you have from these types of accounts past just traditional and Roth IRAs, which are capped at $6,000 or $7,000. There's many tens of thousands of dollars that you can put into one of these types of accounts on an annual basis, whether that's deductible or non-deductible. It's a great amount of flexibility that you have with the amounts that you can add into it and the increase in that over just what you're used to with an IRA. And you have options to do both. You have options to do checkbook control, where you, as the plan trustee of a 401k, can directly write checks out of the checking account for that 401k. You don't necessarily have to involve Advanta in the day-to-day if you're comfortable with making those decisions and having that type of control. We are certainly happy to set up the account where you do have that more direct type of access to the account, and the ability to finance real estate purchases tax-free. We're going to get into some things called unrelated debt finance tax and unrelated business income tax, which are things people run into a lot when looking at financing property purchases, specifically in IRAs. But a really awesome aspect of 401ks and retirement plans of this nature is that you don't have to worry about that for certain types of transactions. So you have a really powerful tool in being able to be exempted from some of those taxes. And with that said, I'm going to turn it over to Larissa. She's going to get a little bit more into what exactly is an employer-sponsored plan. And take it away, Larissa.
Thank you, Alex. And before I go on, I just want to let everybody know that the handout, the slides, are attached as a handout, so you can certainly download them during this presentation. So if you'd like a copy of the slides, they're attached there for you. Click on the download button, you'll be able to save them. I also want to mention that if you want to ask questions, go ahead and type your questions into the chat box. We do keep everybody muted on the webinar just to keep it flowing, but we will take questions, type them in there. We'll stop periodically and check for questions and get them answered for you, and we welcome questions. Please go ahead and ask your questions, because there are people on the webinar that might have the same question as you do, and we want to make sure that we're addressing everything as we go. So what is an employer-sponsored plan? Well, very simply, the employer-sponsored plan is a retirement account set up by an employer, and it can be a sole proprietor. There doesn't need to be any formal entity involved there, but with intentions of making contributions. So the contributions are made by both the employer as well as the employee, or one or the other. There is a couple different types of employer-sponsored plans. We're only going to focus on the solo 401k today, but there's other options available to you if you're thinking about an employer plan, but you're not necessarily looking at a solo 401k as the best account for you. You can also look at a SEP IRA or a simple IRA. These are IRAs and not 401ks, and so they're administered a little bit differently, and we'd be certainly happy to help you with questions on those if you reach out to us directly. But again, the idea behind the employer-sponsored plan is that contributions come typically from the employer and the employee, or one or the other, or any combination of those, with the intention of saving for retirement. And then, of course, the idea behind a self-directed 401k, SEP IRA, or simple IRA, of course, is going to be making those investments that are outside of the market. So we're going to talk about that shortly as well. But we want to talk about really quickly moving money to a self-directed account, because a lot of times people say, well, if I start with a contribution, then I'm not going to have enough money in there to make the investments that I want to make. And the truth is, most of your accounts can go right into a self-directed account very seamlessly. With a 401k, you can use a transfer. Typically, we're going to use a rollover, which we'll talk about in just a second. But either way, you're just going to reach out to us and say, hey, this is where I have my money. How do I get it to the new account that I'm forming at Advanta IRA? And we're going to help you with that. But typically, the definition of a transfer is going to be trustee to trustee, from like IRA account to like IRA account, or again, 401k to 401k, just depending on what it is that you would like to do. It's a matter of filling out a form. We send it over to the current custodian, or we have you do it. And then once they receive the direction, they'll go ahead and send the funds. It's very easy. With a transfer, there's no reporting. And this would, again, be like account to like account. So it just depends on what you're doing. A direct rollover is when you're moving funds from an employer plan over to another type of plan. So that could be a 401k, it could be to an IRA of any kind. And there is reporting done on this one, but it is not taxed, and there's no penalty for doing so. So typically when you're moving from an old employer plan, they're going to file a 1099. But it is going to be coded as a direct rollover, because when the funds are received on the other end, there's going to be some coding that goes along with that shows, hey, this was still under the retirement umbrella and the funds were received, so no taxes are owed, no penalties are paid in that case. So again, old employer plan to new employer plan, or old employer plan to IRA, is a direct rollover. And again, really not necessarily something you have to remember. We're going to help you with that if you open an account, but just for your peace of mind, these things can be done, and you're not simply starting a new account and relying on your new contribution to make those investments that you want to make. We also want to talk about your investment options very quickly, because with a self-directed account, there are so many options. We don't help you with those things that are in the market. That is for your brokerage firm to help you with. And so we're really not competing with them. What we're doing instead is filling the gap in the industry, in where you can make these investments and hold a brokerage account as well, and make those investments as well. So here, what we're holding at Advanta are things that we consider private investments, things like real estate. So buying and holding tangible real estate, whether that's for short-term or long-term rentals. You could buy single-family houses, condos, duplexes, multifamily. Any of those things will work in a self-directed account. You can also lend money. So be the bank in your 401k or IRA. And actually, we have a whole webinar dedicated just to that information because it is a very common investment we see at Advanta. You can use a single member LLC. A lot of times those are used for checkbook controls with IRAs, private placements or private stock. Again, very common. And again, brokerage firms just simply don't hold those assets. I think there was a time maybe where they would hold them on occasion, but just simply because of the changes in the fiduciary laws very recently, those sorts of private placements are also having to find new custodians because the brokerage firms no longer want to be responsible for those types of investments. And then, of course, we have foreign currency exchange, which is Forex, and we also see futures, options, precious metals. There are so many other things that you can do. And as a matter of fact, the IRS hasn't said these are the things that you can do. They've instead said these are the things that you can't do, and just about the sky is the limit for all other investment types. There are a few people you can't transact with and a couple of asset classes that you cannot make investments into, and we'll talk about that in just a minute. So key components of an employer plan, and that's very important because you want to sort of understand what the employer plan encompasses. And so if you are eligible, if this is something that you're looking to use as an investment tool and a way to save for retirement, here's what makes up the plan. So first, a sponsoring entity or sole proprietor. So I want to be careful here because you can just have a sole proprietorship and have a 401k that is allowed. So some sponsoring entity or individual, an employee or a business owner. And this is important here because when we say employee, we're talking about the business owner as an employee, or the business owner as an employee and their spouse as an employee, or the business owner and their partner. All other employees would not be allowed in a solo 401k, so that's important to understand. If you have employees, the solo 401k may not work for you. It just depends on whether or not your employees are eligible to participate in the plan. And we're going to very briefly touch on that. But again, if you have questions, reach out to us directly. And then basically making contributions. So with a solo 401k, and we're going to talk about how contributions work, yourself as not only the business, but as the employee can make contributions to this plan. And again, take advantage of the much higher contribution limits that you would have in a 401k. And another thing that I want to mention too, and I think we touch on this a little bit in a few moments, but I want to mention that if you have a 9-to-5, so to speak, but you also have self-employment income from a side business, you are still eligible for a 401k, even a solo 401k, even if you are participating in your current employer's plan. So they have the larger plan that more of us are familiar with, a corporate type of 401k plan, and you might be contributing to that, but you would also be eligible to have a solo 401k and contribute to that plan as well based on your self-employment income. Alex?
Yeah, absolutely, Larissa. All really great points. So I'm going to get into the aspects of what are some of the benefits of a solo 401k. And again, these can be extrapolated to larger 401ks as well, but it's not really kind of the business that we get into. We specialize in compliant 401ks that are just based on the ability of the sole business owner, sole proprietor, self-employed individual, and we'll get into that a little bit later. But when I say solo 401k, these do have bearing on slightly larger plans as well. So some of the advantages, you get much higher funding limits, and Larissa will get into that in a moment. But the cool thing about this is that with a 401k, you have the ability to add in employer contributions, meaning that you take money that is based on your income. So what you're paying yourself of earned income, typically you see that as W-2 income. It doesn't always have to be W-2 income. It can be income that's paid out on a K-1, depending on maybe you file as a partnership or other type of entity with regard to that. So it doesn't always just have to be a W-2 income. The primary thing to look at when looking at the ability to take that and make your employer contribution is the fact that you are paying your FICA tax from those funds that you are receiving. And then you also have the employer contribution. Now, the employer contribution is kind of a cool aspect. It's the ability to take a portion of the net operating income of the business and contribute it to the plan as well. Most people will see this in a more traditional sense as an employer match. If you have a larger 401k and they say, hey, we'll match 4% of whatever you put in there up to a certain amount, that has bearing in the employer portion of the contribution. Now, the great thing about doing this in a self-employed individual fashion is that you get to take advantage of the full amount of that contribution limit, which is up to $35,000, which is really cool on that aspect. And you get to kind of bifurcate the deductions that you are potentially taking to corporate and personal, and then also potentially if you are filing as a pass-through like an S corp, then you get to potentially take a lot of deductions personally. Now, you also have the ability to roll over other 401ks into a solo 401k, any traditional IRAs into a solo 401k. And although you can have a Roth 401k, you cannot roll over a Roth IRA into a Roth 401k. It's a strange rule, but unfortunately that's the playbook that we gotta play with. Now, there have been some updates with the CARES Act. Now, for those of you that are unfamiliar, the large piece of legislation that was passed back in, I want to say, the beginning of May, the CARES Act, which a lot of people heard about, which was changing some rules with regards to distributions and rollovers from retirement plans. It changed also the amount of money that you can take out as a tax-free participant loan from a 401k. So 401ks have this really interesting aspect of them that allows you to borrow against that 401k plan and then repay those funds back into the 401k plan at a point above or below prime. It's just as if you had gone to anyone and borrowed money and you repay them with interest. You get to do that to your 401k. Now, previously, you were limited to either $50,000 or half of your total vested balance. That has been increased to $100,000 of your 401k, not to exceed 100% of the vested balance. Now, that allows you to take that money out, use it for personal needs, and then repay that over 5 years. And with the CARES Act, you also do get exempted from the first year of payments, although then in turn you would have to increase your, your amortization schedule to make up for that, to repay that within the 5 years. Now, we're going to be talking about UBIT tax, but more specifically, it's the subset of UBIT, which is unrelated debt finance income tax, which is subject to the leverage in real estate deals. Now, for all intents and purposes, UBIT is calculated exactly the same. Most people use it interchangeably. So if you do hear us refer to UBIT or UDFIT, for the purposes of this presentation, and we'll get into the slight difference, they're more or less the same. But with IRAs, when you borrow money to acquire real estate, you have to pay a tax. There's a tax associated with the applicable income that is derived from the finance portion of that deal that you have to pay as a tax to the government in order to be able to be involved in that deal. 401ks are exempted from a lot of that, and it's a really cool way that you can get very large gains within a 401k by utilizing debt financing that you don't have within an IRA. And with what Larissa was indicating with being able to self-administer these types of plans, you can also have very, very cheap administration as opposed to larger 401k plans, which can be significantly more expensive to administer. There are a lot of options with how you actually administer these plans that can greatly reduce the amount of funds that you pay in administrative costs. And you also do have the ability to have a Roth 401k. Just in a 30,000-foot view, traditional monies, when people refer to traditional IRAs or normal regular 401ks, you're making pre-tax contributions, meaning that the funds that you put in there are deductible and you have not paid taxes on those yet. Now, that's all well and good, but let's say you don't want to take a deduction. You'd rather just have the money go in after tax, just as you will with a Roth IRA. You can do that with a 401k as well, and you can do that with your employer portion, and then you can also convert you can do that with the employee portion, and you can convert the employer portion, so you can get tens of thousands of dollars into Roth 401ks in a given year. That's a little bit more of a conversation for a different day, but just understand that you do have the ability to get significant amounts of money, either traditional or Roth, into these types of accounts. Now, what are some of the benefits of the solo 401k? You have the Roth 401k. As the business owner, you're kind of wearing two hats, the employer and the employee. When the employee makes contributions, you have the opportunity to make contributions up to $19,500 for 2020. Now, that means that you can pay yourself $19,500 of earned wages, and you can contribute that directly into the account. Now, you need to pay yourself a little bit more to qualify your tax liability for that, but unlike things like a SEP IRA, where you have just a rolling calculation of 25% of compensation to calculate your contribution to that plan, you don't have to pay yourself a ton of money in order to be able to max out a portion of the contribution to that plan. Now, you can elect to make that as a non-deductible contribution, which would be a Roth contribution to that plan. So for individuals under the age of 50 and a half for 2020, that's $19,500 that you can put in directly as a Roth contribution to a 401k on an annual basis. Now, the traditional combination of the two, you can do either one or the other. You can do a combination of both, but they just can't exceed the $19,500 limit. So you could split that in half. You could do $500 as Roth. You could do $19,000 as traditional. You just have to keep in mind that when it comes time to actually tracking the underlying basis for the Roth and traditional, you need to keep that in mind if you are going to be commingling your contributions into that. There's a few different ways to do that. Again, that's a little bit more of a conversation for another day. And I do see that someone has their hand raised. Please type your question in. I am myself or Larissa are more than happy to address the question. If you do have a question or an issue, please just type that into the chat box. We'll get to that immediately, but we don't necessarily go through the raised hand for individuals, so please just type that question in. And again, the contribution limits are significantly higher than they are for just regular Roth and traditional IRAs. One last item before I kind of go through just some of the nuts and bolts of this. Well, I remember what it was. So just keep in mind that the employer contribution, so that portion of the net operating income that you're contributing into the plan as an employer match, keep in mind that always has to be made traditional. You cannot do that immediately as a Roth contribution. It has to be done directly as a deductible contribution. And it looks like we have one question, and it's actually very pertinent to this, is what is the contribution for over 60 years of age? So it's actually a little bit before that. So individuals over the age of 59 or over the age of 50 and a half get an additional $6,500 of employee contribution per year. Now, if you look at the slide right in front of you, I won't go over too much of everything up at the top. So the traditional 6 or 7, the SEP up to 57,000 or 25 compensation. Simple IRAs are an incredibly terrible name for an incredibly complicated plan to administer. I say that with a little bit of jest, but they are rather complicated. So with a 401k, we mentioned that $19,500 is what you can take of your compensation and just directly plug into that plan. Once you reach the age of 50, you get an additional $6,500 that you can put into that plan on a given year. So $19,500 plus, plus $6,500 additional of salary deferral, and then also 25% of the net operating income of the business can be contributed into that as well. So that's where you kind of get that additional amount of funds that you can add in if you're looking for what is considered a catch-up contribution for 401ks. And just to kind of round it out, we also do offer Coverdell's and health savings accounts. Not a whole lot has changed with the ESA. I think that has been $2,000 since I started working here in 2012, and I'm pretty sure it was the same thing in 2011 when Larissa started. And then also health savings accounts we offer $3,550 for individuals and $7,100 for families if you're looking to do an HSA, which we'll probably be doing another presentation on here coming up shortly because open enrollment is starting. So just keep that in mind. You know, it's always good to take a holistic approach when it comes to retirement planning and different accounts. Obviously, we're covering 401ks today, but there's also a need for a lot of other stuff coming up in the future. And with that said, I'll hand it back over to Larissa to cover a little bit more about how the contributions work and break down.
Yes, thanks, Alex. So we're going to talk about a third type of contribution, and before we go into the details on that third type of contribution, we just wanted to give you an illustration here on how that works. So again, Alex went over the contribution limits for the 401k plan. So for 2020, that's 57,000 or 63.5 if you're over the age of 50. So here's sort of the way to look at it is I like to kind of envision or visualize the contributions being made into buckets. So you have your employer contributions, again, 20 to 25% of your earned income. You're going to put your employer contribution into one bucket. Remember that that's always pre-tax. Then you have your employee contribution. It can be Roth or traditional or any combination of the two, depending on what you want to do. Again, 19,500 for 2020 or 26,000 if you're over the age of 50. When you put money into the employer contribution bucket, if you want to move it over to the Roth bucket along with your employee contributions, if you choose to make them that way, you can certainly do that. You just want to make sure that your plan allows for it. And remember that the combination of these two contributions is going to be up to 57,000. Well, a lot of times based on what you pay yourself or what your salary might be when you're self-employed, you might not get up to 57,000 because you take 20 to 25% of your earned income as the employer contribution and another 19,500. Adding those two might not equal 57, but this third type of contribution, the employee after-tax non-Roth contribution, will help you get up to that amount as long as you have it in earned income. So let's just talk about that quickly, and I'll kind of go over how that works. So here's a great example. An employee after-tax non-Roth contribution is basically what some would consider a mega Roth contribution. So our next slide will go over that as well. But the mega Roth contribution is essentially, as long as you've had it in earned income, the contribution can be made into the account up to the annual limit for 401k. So again, 57,000 or 63.5, and basically makes up the difference of what you weren't able to put in based on the formula. So in this example, John is a sole proprietor, so he gets 20% employer contribution and 19,500 as the employee. If he had a salary of 100,000 this year, here are his calculations. The employer would be able to put in 20% or 20,000. As the employee, he can put in 19,500. Well, that doesn't get him up to 57,000, but now because his plan allows him to, and again, it has to be allowed by your 401k plan, he can now put in this after-tax contribution and make up the difference of 17,500. So my next slide is really going to detail this contribution type for you. So it is considered non-Roth because although it goes into the plan after tax, it is going to be considered tax deferred as it grows. So again, it's an after tax contribution. It's put in after tax, but it's going to grow tax deferred rather than tax free. So it is not technically a Roth contribution. How do you calculate this contribution? Well, you're going to take the annual limit and subtract the employer contribution plus the employee contribution, and you are going to get that after tax contribution. You can immediately convert this contribution to the Roth portion of the plan so that it grows tax-free. This is really technically just a matter of paperwork, but you want to make sure that you take that extra step if you want those funds to grow tax-free. If your intention is not to have them grow tax-free, or your plan does not allow you to do the immediate Roth conversion, or they call it an in-plan Roth rollover, typically, then you would have to keep track of that contribution as after tax. And of course, the earnings are going to grow tax deferred with the rest of your traditional funds in the 401k, but you are going to want to keep track of that contribution itself if it's not going to be immediately rolled over to a Roth portion of the 401k, so that when at the end of the plan, when you close the plan out, you can roll those funds directly to a Roth IRA because they went in after tax. So that's important. You must have enough in earned income to cover the total amount in contributions you're making. So if you only paid yourself $40,000 this year, you want to keep in mind that then you would not be able to maximize the contribution. And this is definitely something to talk to your CPA about, to understand how to make sure you have enough in earned income, how to calculate the total amount you'll be able to contribute, and how to track those contributions. It's all very important. And again, your plan must allow these options. And I really think our plan is awesome. It really covers all of the options we're talking about today. But if you're not a client of Advanta and you're working with another administrator, make sure that your plan includes these options. They're very important. They're going to really allow you to put away a good portion of your earnings for retirement income later on. And so Alex really already sort of mentioned the loans to participants, but another great benefit of a solo 401k is the ability to borrow from the plan. So an IRA cannot lend money to the IRA holder. So that just doesn't work with an IRA. So a lot of times when we're working with investors, they say, well, I have money in my IRA. I want to borrow it so that I can buy a rehab property, flip it, and then I'll pay it back. And unfortunately, that is just simply not the way an IRA works. With an IRA, you can invest in assets that you don't already own, that is new to you and new to the IRA, and then the income is going to 100% go back to the IRA. But for the 401k, if there was some investment you wanted to make personally, if you had some need for the funds, you have the ability to borrow from the 401k plan. And Alex mentioned also that because of the CARES Act provisions, it's now up to $100,000. And I do also just want to qualify that quickly because you do have to qualify for the additional amount in for the loan or distribution or anything you're thinking about utilizing CARES Act provisions for. So just be aware of that. The typical loan from a 401k plan is going to be $50,000 or 50% of the amount in your account for the plan, the lesser of the two. If you qualify for CARES Act provisions, then it would be, as Alex mentioned, up to $100,000. And it could be $100,000 only in the account, and you could still take that amount. So a little bit different than what would be considered normal. Something to note: this is a normal loan. You do want to be aware of that. There is interest being paid, and even though you're technically paying it to yourself, there is interest paid. It should be fair market value. And also there are repayment terms. So you want to make sure that you're making that monthly, or I think, Alex, correct me if I'm wrong, you can also make it quarterly. Is that correct?
You have to make at least a minimum of a quarterly payment. Now, with regard to that, the CARES Act does exempt you from the first year of payments. But I think I kind of briefly mentioned earlier that you do need to make sure that you adjust your amortization schedule to accommodate if you are going to be withholding from that first year. But yes, at least a quarterly payment. It can be interest only, so you don't necessarily have to pay it on principal, but just keep in mind that you would have a rather large, we'll call it balloon payment at the end of the term of that note if you elect to do so.
And you do want to make sure, and I think so many times we get a phone call from somebody who says, well, I took a personal loan for my 401k and I haven't made a payment. What do I do? When do I have to have that paid back? So you do want to understand that it is a structured loan. You do want to make those payments and make sure that you intend on paying those funds back to the 401k. But again, it's a great benefit. You have the ability to utilize those funds differently than you would an IRA. Alex?
Yeah, absolutely. Thank you. We have a couple of questions. I typed in a few while you were speaking, but we have one. So if my salary is $50,000 and the employer match is $10,000, can the employee after-tax non-ROTH contribution be $27,500? Well, that's going to depend on one, making sure that you are. Let's see. It looks like you are able with the amount of funds that you are being paid, and your age is the other determining factor. So as long as you are old enough, being over the age of 50 and a half, you do have the ability for that $6,500 catch-up contribution to quantify that additional amount of contribution. But one sec. It would actually be $26,000. Not $27,500. It's the it's $19,500 plus $6,500. So you're looking at a little bit less than what you had indicated on there. But yes, you can get very close to that number that you're referring to. Now, just to kind of go back and since we're on the topic of the CARES Act and COVID, I'll just read off a few things. I'm actually working through a few things personally, and I have a list of some stuff up there that has the specifics of COVID-related things that would qualify you for either the distribution or the additional loan amounts. So you have to have been diagnosed with COVID-19 by a test approved for the CDC, your spouse or dependent has been diagnosed with with COVID-19 coronavirus, you have experienced adverse financial consequences as a result of being quarantined because of COVID-19. They do leave these very open-ended to make sure that anyone that is affected can take advantage of these things. So, you are self-certifying these things. If you have been laid off or furloughed because of COVID, you are unable to work due to a lack of childcare because of COVID, or if you have closed or reduced hours of a business owned or operated by you because of COVID-19. These are all the qualifying things that the guidance we have gotten thus far. I would anticipate they might expand this. Keep in mind that with the nature of this being so unknown, that it is a very dynamic situation, and things are changing almost daily with regards to some of this. So that's what's currently out there for quantifying you for the additional coronavirus loan amounts. So with that said, yes, the qualified plan or IRA or both. So you can contribute to both so long as you have enough earned income. So if you're an individual and you're only paying yourself the bare minimum to make your maximal employee contribution to the plan, you wouldn't necessarily be able to max out both the employee contribution portion of that plan and an IRA. But if you do have funds that have been paid out to you as compensation that qualifies above and beyond that, you can certainly take advantage and contribute to both and potentially max out both as well. Now, keep in mind that you may not necessarily be able to contribute directly to a Roth. There are phase-out limitations for individuals earning over a certain amount. And for the year of 2020, you are phased out if you are a single filer or head of household at $139,000. If you are filing a joint tax return and make over $206,000, you cannot make a direct contribution to a Roth IRA. However, that in no way means that you cannot still make a contribution to a Roth IRA. How does this work? Well, you simply just make the contribution to a traditional IRA and then convert it over to the Roth IRA. So there's always a way to do it. Some people say, oh, well, I don't qualify for making that Roth contribution. It doesn't matter. You can do it to the IRA just so long as you do the proper mechanism. And the nice thing with a 401k is that there is zero income limitation phase out. So you could, if you are making $1 million a year, fantastic for you, but still make that as a non-deductible 401k employee deferral to that plan. So the income limitation MAGI phase outs are not applicable to doing Roth deferrals to a 401k plan. Now, you would need to check with your CPA to find out if your traditional IRA contributions will be deductible. Again, that's based roughly along the same lines as the Roth IRA phase-out limits. So just keep in mind that your deductibility or your ability to do things directly may be affected directly if you're a high wage earner, and also depending on how you file your taxes as well. Right. Okay. So now, I mentioned in the beginning of this that we were focusing mainly on solo 401ks. Now, obviously, companies like GE and Boeing that have tens, if not hundreds of thousands of employees have 401k plans. Now, there are different types of regulations that come into play when you have actual rank and file employees. Essentially, for the purposes of what we're talking about, is that if you have any non-equitable owner that is not a contractor working for you, they are not over the age of 21. They are not a non-resident alien and non-union. You typically have to include those people. Now, with the Secure Act, which was another piece of legislation that was passed pre-coronavirus really coming into play, this was a piece of legislation that was pushed through towards the end of 2019, going into effect January 1. A bunch of really interesting stuff came through with that. I would highly encourage you to listen to the webinar. I believe I taught that one on the, I actually think I taught two of them with some updates on the Secure Act. Changed a lot of things. One thing being what constitutes an employee for being able to qualify for a solo 401k. Now, it used to be significantly different. Now, those individuals have worked at least 1,000 hours per year still qualify. And that was the main driving force before, was that if you worked over 1,000 hours a year for someone, not as a contractor, not as someone that's 1099, you had to include them in the 401k plan, which then would have kicked in what's called discrimination and plan testing. It's just a lot of paperwork and compliance that you have to do to make sure everyone in the plan is being treated equally, that higher compensated employees are not being given any undue benefit. The list goes on, but essentially it just means for the purposes of this presentation that your 401k plan gets a lot more expensive to administer, or that individuals have worked over 500 hours over 3 consecutive years. Now, keep in mind that that's a big change. The 500 hours over 3 consecutive years is the big change, because if you had a gap in employment for the 1,000 hours per year, then they could still be excluded. But with the 500 hours for 3 or more consecutive years, then they have to be included in that plan. So it's definitely something to keep in mind, especially if you're a small business. Not to say that you should, structure your business to try to exclude employees by any means, but depending on how you run your business and the intention of employees on actually wanting to participate in the plan, there is some flexibility there. You as the business owner can certainly structure your business the way you see fit, and some business structures might lend themselves to, unfortunately, not being able to utilize the solo 401k plan, even if in principle you pretty much are you are a sole proprietor or a self-employed individual. Okay, Karen asks, this is a good question. Does the earned income have to come from the business, or can it include another job? Very good question. So especially going back to Larissa's point of the amount of money that you are being paid out from the business being able to be contributed in to that plan if you have a separate business. If you work 2 jobs, you can have a solo 401k if you have a side business. Now, let's say you make $250,000 in your 9-to-5, and you sell widgets on eBay as a side job, and you make, let's say, $10,000 doing that job. You cannot max out a solo 401k for that other job. You have to base it strictly on the $10,000 of earnings that you made in that other job, even though you may certainly have enough cash and capital to max out the contribution to that plan. It has to be derivative income from the business that the 401k plan is tied to in order to qualify those contributions that you are making into that plan. So certainly a great question. Thanks for asking. We get that from time to time, but it is very important to remember, especially for people who maybe, especially in our industry, are part-time real estate investors and then also have a 9-to-5 job. You got to really be careful about where you are pulling those funds from and what type of earnings are attributable to what activities you're actually doing. All right, next slide. Just want to double check something real quick. Okay, so some of the self-directed 401k rules. Now, with regard to this, excuse me, the prohibited investments that you have for an IRA still maintain within the construct of a 401k. You can't buy anything that inherently is deriving its value from collectability. So that's things like antiques, alcohol, artwork, stamps, coins. Some coins are allowed, and I actually just taught a webinar last week on buying precious metals within an IRA. So long as that the metals meet a minimum fineness requirement, you can actually buy gold, silver, platinum, or palladium within a retirement plan, which obviously you can utilize as a hedge against inflation with the crazy times we're going through right now. That might be certainly something that you may be interested in doing, and it is certainly an allowable investment. Now, what are some prohibited transactions? Now, those are really the only things that you cannot invest in, are just collectibles are really just collectibles with 401ks. With IRAs, you cannot directly invest in life insurance. There is some flexibility with investing in certain life insurance products with 401ks. Those are really specific instances, but I did take that out of there just because it is not it is not universal that is a prohibited investment for a 401k. So for IRAs, that is a little bit different, but for the most part, insurance products, as far as life insurance products, are also off the table. There are certain qualifying ones you would need to check with the underwriter for that particular contract to see if it qualifies. Now, prohibited transactions. There are people that you cannot directly deal with regard to the plan. Those are called disqualified people. You cannot directly buy or sell anything to anyone that is a direct lineal descendant or ascendant of you personally. So you cannot directly deal with yourself. So if you own you own a piece of property, you can't sell the property to the plan. If your son or daughter or mother or father own a piece of real estate or any asset for that matter, you cannot sell or buy anything directly from them. Your siblings, go for it. The IRS is kind of odd on that one. I think it's a little bit strange, but they don't have a problem with siblings. Now, UBIT and UDFI, these are more or less one and the same beast when it comes to how they are calculated and paid, but where they are generated is a little bit different. So unrelated business income tax applies to business income, not investment income. So if you were to buy a laundromat, you bought the laundromat as an LLC, the 401k became a member of that LLC and it owned the laundromat, you would have to pay tax on a portion of that derivative revenue and pay that to the IRS on Form 990T. And it can apply to some private equity investments depending on how they are structured. It is a very lengthy topic to get into, so we'll keep it rather brief on the two. But the more specific one that would apply to IRAs a lot of the time is unrelated debt finance income tax. We deal a lot in real estate, and more often than not, people, when it comes to buying real estate, have to borrow money. Think about your personal residence. A lot of people take out a mortgage or borrow money in order to acquire real estate. Now, if you do that in an IRA, you automatically, no way getting around it, are going to be subjected to unrelated debt finance income tax, or UDFI, which is calculated and paid exactly the same way as UBIT. So that's why some people interchange them a bit. But if you buy a piece of real estate with a 401k for the acquisition of new real estate, 401k plans are exempted from UDFIT taxes, which is a hugely powerful tool if you're coming into this from the perspective of wanting to do real estate investing. Looks like we have another question. If I have long-term capital gains from an investment in an LLC, can I use those long-term capital gains as qualifying income to contribute to a Roth 401k? Typically, no. Unless those long-term capital gains are somehow inclusive of a greater compensation package that would be subjected not to capital gains rate taxes, but that would be exposed to FICA taxes or minimum required or alternative minimum required taxes, Social Security, things like that. Typically, that is not going to be something that you can use to contribute to a Roth 401k. Again, I'm learning new things every day, but just on face value of what you're asking, I would typically answer that question as no. All right, next slide. And just a little bit of an illustration of showing you disqualified persons. It's easy enough for me to kind of use the investment jargon of lineal descendants and ascendants for you in that. But here's it kind of played out: is that if you are the plan owner, you cannot deal directly with anyone above and below in this chart or to the side of you, meaning your spouse, and that includes anyone that is legally married. That is the legal definition of it. So if you are legally married, or if they are your primary beneficiary of your estate, you cannot directly deal with them in the middle section of being a spouse. And then also business entities owned or controlled by any one of the individuals on here also are also out. And before I hand it over to Larissa, we have a question over here that I got to expand the window on to look at. This is a big one. So let's see. I have a self-directed IRA currently that passively invests in private placements that are owned apartment communities with financing. Seeing the benefit of that not subject to UDFI taxable solar 401k, if I roll over the ownership from a self-directed IRA to a solar 401k, meaning to have the private placement to update the operating agreement membership schedule, would that trigger do-it sale clause, and would it create any tax consequence to do the rollover? So a few things to dissect with this. For everyone, what the individual is asking is that they've invested into some type of partnership that is invested into a apartment community that has debt financing that was used to buy the actual property. Now, with regard to these types of structures, typically they're always done in some type of either limited partnership, an LLC. The deed is not going to read with each individual investor. You're going to look to the limited partnership agreement or the schedule of the investors of the LLC. Now, if this individual wanted to roll that interest from an IRA to avoid the debt finance income tax to a 401k, that certainly would be an avenue to look at. I don't think that there would be a due on sale clause with regard to the bank because the actual owner of the property is not changing. Typically, shares of limited partnerships are traded and sold. People die, things happen. And typically, I haven't seen a due on sale clause be triggered for a limited partnership of a larger organization like that. If you're just rolling it into a different type of an account, think to the point of if you change custodians. If you came from another custodian to Advanta, there would be a change of ownership essentially from IRAs, and that wouldn't trigger a due on sale clause. So I don't think that would be an issue. And as far as the new tax consequences for the rollover, there would potentially be a tax benefit, not necessarily a consequence of you being able to exempt yourself from the debt finance income tax attributable to that type of investment through an IRA. So good question. Like the detail on that one. And with that, it is time for me to turn it back over to Larissa.
Well, I think that Alex really went into this and over this in great detail, especially with the last question that we have. So I won't really go into it too much more, except for just to say that remember that it's for acquisition of new real property that exempts you from the UDFIT. So, if you're borrowing in some other capacity and the borrowing is not tied to real estate, UBIT or UDFI is still going to apply. And then, of course, the trade or business underneath the 401k, again, UBIT is still going to apply. So if you have more scenarios for us asking about UBIT, please get them in there, or you can reach out to us again directly to find out more about how it works. Ultimately, at the end of the day, if you're making an investment and you're feeling like this is going to be considered business activity and you're not sure how it works, you can reach out to us, and then we'll bring your CPA in as well to go over what really is going to trigger the tax so that you're aware of how the investment works. We also mentioned at the very, very beginning of the webinar that you have the ability with a solo 401k to have direct checkbook control. So what this means basically is that if you have an IRA, that account does not inherently have checkbook control. You have to have a separate entity set up with the IRA making an investment into that entity to then obtain checkbook control. So it can be an LLC, a personal property trust, in some cases a land trust, but that's how an IRA would gain checkbook control. But just based on the nature of a solo 401k, you can have checkbook control of this account, and it's actually done very, very easily. So when you come to us and say, okay, I'd like to have a solo 401k with Advanta, what do I do next? The first thing we're going to ask you is, well, do you want checkbook control? Because if you do, that's a separate application than if you want to go with what we consider the full service model. So here in this example, we have John as trustee, and we're giving you sort of the how-to with checkbook control and the how-to with a third-party record keeper, or what we call, again, full service. So John opens an account with Advanta. Does he want checkbook control, or does he want to go with Advanta as his checking account? And so if he wants checkbook control, essentially he is not only the trustee, but also the administrator on the account. He's going to adopt our plan. Advanta IRA is simply going to lease him plan documents. So the IRS requires that you have an approved set of plan documents in order to qualify your 401k. So that's what we provide to John in this case. Once we provide that to John, he will be able to take his adoption agreement plus the plan documents, go to a bank, and open an account in the name of the 401k. And this can sometimes be tricky. I'll give you a little warning there. Sometimes banks just simply don't understand these types of accounts. They're not sure how to hold it. They immediately would say to John, well, we can open up an IRA for you here, but we don't do 401ks. That's really not what John is looking for. He's just looking for a simple checking account with the title on that account being his name, comma, trustee of, and then I just gave you an example, Smith 401k plan. But they're actually not doing any reporting for the 401k itself. They're going to do all the normal bank reporting for the checking account. John will have a TIN or an EIN associated with the 401k that he'll provide the bank for their purposes for reporting. But then John, as trustee, is going to file any tax forms needed. So that's the 5,500 as well as a 1099 if there's ever an instance where that would apply for John. He's going to sign and execute all investment documents. So again, the bank isn't involved here. He's going to make his contributions, and also he's going to keep track of those contributions for tax reporting purposes. So again, the bank is not involved there. And he's going to handle funds in and out of the account associated with investments. Again, bank is not involved. For their purposes, this is just a checking account. And a lot of times we find that banks want to treat it as a trust checking account, and that will absolutely work. John is the trustee. He can provide them with the 401k plan documents, which are treated as trust documents. So he would be all set there. And we will also provide John with a letter to the bank saying, hey guys, if you have questions, this is how you hold the account. Please reach out to us so that we can work out any details that the bank needs to work out. Sometimes they need to have their compliance department reach out to us and get the okay before opening the account. With Advanta IRA and the full service model, what we're going to be doing there again, John is still going to file the tax forms, so we don't do the 5,500 or the 1099. He'll still sign the investment documents and calculate his contributions, and his assets will still be in the name of the plan. But what has changed now is he has a full service account manager helping him, assisting him along the way. So when John says, hey, I'm going to lend money, I'm not really sure how this works. Please walk me through it. We have the ability to say, okay, send us the forms. We'll highlight where John needs to make sure the plan name is, where his signature is going to go, and how to handle the vesting of this asset and going forward payments to the plan, expenses to the plan. Any of those things are going to be done by Advanta IRA. So John has that assistance along the way. And, you know, Alex and I are always available to help our checkbook control clients as well. They can reach out to us with questions, but we can't review any documents because we simply have not been basically employed in that manner by our client who has checkbook control. So we would be happy to answer questions, but ultimately it's going to fall on them to make sure everything is vested properly and funds are going in and out of the account properly. With the full service model, that's what your account manager is there to help you do. So, you know, when you're opening the account, a lot of times we'll talk to people who are just not sure about how to handle checkbook control. And so they might start with the full service model and then later on down the road move to checkbook control where they feel like they have a good handle on it. They've seen what paperwork we need to see and what we've kind of walked them through. And so now they're ready to have checkbook control of that account. And certainly you can still use an LLC or an additional trust if you feel you would like that, either with checkbook control or with the full service model, whichever, you know, it might be for legal purposes, it might be for anonymity, whatever the purpose is, you can still use those entities. But with a 401k, you do not need that in order to have checkbook control of that account. So again, just very quickly, third-party administrator versus what we call a DYO or checkbook control account. Cash and assets are administered through the third-party checking account. So essentially, Advanta IRA would be your checkbook in that scenario, or John can have a checking account at his local bank. A lot of times people just see the benefit of that for ease of transactions when they want to do a deal over a cup of coffee and a handshake. John ultimately in either case is going to sign the documents as trustee in both models, and John is going to be responsible for doing all of his due diligence on all of the investments. So John is still directing the account. He is still the trustee of the account. He is still making all the determinations that kind of fall under making those private investments, but how much help does he feel he needs is really what it comes down to for the two separate options. And we have a 401k guide. It outlines those options and gives you a table of what John might do in this scenario versus Advanta IRA, depending on the option he chooses. So we have a lot of classes. They're going on all the time. They're always no cost, no obligation. And the easiest way for you guys to find those classes is going to be to just go to advantaira.com/events. That will take you to our calendar of upcoming events. We have a lot of stuff going on, and we have something specific I'm going to talk to you about in just a second. You can always check out any of our archived webinars through our video library or going to YouTube and search Advanta IRA. Everything gets posted there. This webinar will be posted there as well. So if you would like to review it, you'll have the ability to do so. You'll also get a link through a thank you email. So again, that link will be shareable if you have somebody that you think would benefit from hearing the webinar. And also we have a blog, and the blog is always sharing the latest in industry news, updates, and insights from team professionals. We're also always looking for topics that you guys would maybe like us to cover. So if you have an idea for a topic that we didn't cover, please feel free to reach out to us, and we'd love to hear from you. It's really easy to get started. Again, Alex mentioned reaching out to us. Reach out to us directly with any questions. If you're thinking about getting started, we can help you with that. We can get your account open, set up basically in one day, and then we'll help you move the funds over. The event that we have going on this week that I did want to mention is open to everyone. So you can be new to investing. Maybe you haven't even made your first investment yet, all the way through to seasoned investors. We invite everybody to join us for our Pitch, Promote, and Prosper event. It is this Friday, September 11th at 12 o'clock Eastern Daylight Time. We'd love to have you guys join us. This is what we call a haves and wants style meeting. So if you haven't networked with like-minded investors before, a haves and wants style meeting is basically just giving everybody the opportunity to introduce themselves and talk about maybe what they're looking for, pitch an investment, talk about what they have and they're looking to sell. If you're looking for partners on a deal, this is the place to do it. We're going to give everybody the opportunity to that would like to. So Alex and I will be hosting. We'll call your name. If you want to pass, you can simply say pass, or you can say, I'm looking to raise capital. I'm located in this city. This is what I'm looking for. So share your contact information. I just had somebody ask me if they would be able to find somebody that's making the same types of investments that they are in order to sort of collaborate. And I said, join us for Pitch, Promote, and Prosper, because that's the perfect forum for you to talk about what you're looking for in a partner and post your contact information. So we've had a great success with these, I would say, right, Alex? I mean, I feel like we've had a good number of people on since we started it.
I think that's a relatively modest way to put it. To give people some metrics on it, Larissa and I hosted the first one probably about 2 months ago, maybe 3 months ago now. And on the first call, we had, I believe, 25 people on it. And the last call that Larissa and I hosted together, we had over 100 people. I think it was close to like 115 people on that Zoom call. So it is people from all over the country, all over the world. We had people that are investors from places as far away as Hong Kong tuning in to this. So if you're looking for investments in certain parts of the country, it is a wonderful event. It keeps getting bigger each time, to the point that we're having to look at how to, organize the meeting a little bit more effectively because, we've grown so well with it. And again, that's Larissa and I will be hosting that one this Friday. We'd love to have you on there. It's great. You can pitch, you can listen, you can post a question. Sometimes we have guest speakers. We don't have one for this Friday. So it's just going to be investors pitching deals, trying to make deals happen. And we're really happy and proud of where it's going. So we'd really like to have you on there for it. We do these things for the benefit of you as the consumers of our content to hopefully get something good out of it and, make the best use of the current situation we're all in with COVID, not being able to be together and go to these networking events to try to help, facilitate the deals getting made. So, I'm a big fan of it. I can't say enough for how big of a help Larissa's been with that. And, together we've made some real strides in it. So please join us.
Yes, absolutely. Thank you, Alex. And it really has been, it's a Zoom call. So if you're not familiar with Zoom, reach out to us. We'll walk you through it. It's very easy to do. Click on the link, register. And then once you register, you'll get the link to join. You click on it. You don't have to use your webcam. You can just do it audio. So you can join by phone if you prefer. And then, just listen in. Listen to what everybody else is talking about. We will normally throw out a few questions for discussion as well. So it has been a lot of fun. Here's our contact information again. So if you guys have more questions for us, please reach out to us. Again, you can download the slides as a handout from the chat box. It's up there. You have the opportunity to do that and reach out to us with any questions. I did not see any other questions pop up, so I think we're ready to wrap it up.
Yep, no, we're running a little bit over time, so we'll let everyone get back to their days. But thanks, Larissa. It was a pleasure, as always, doing one of these with you, even though we are respectively doing them from our homes together. So, if anyone has any questions, feel free to reach out to Larissa or myself. I would say that if you have questions about the Mega Roth, I'm certainly capable of answering them, but I would point you over to Larissa on that side. Anything else, I'm certainly happy to answer your questions on, and Larissa likewise. So thanks everyone for joining us today. We'll go ahead and stop the recording and let everyone get back to their day, but thanks for joining.
Thanks, Alex.